The global currency market, a vast and intricate financial ecosystem where trillions of dollars change hands every single day, operates on a foundation of established rules, economic realities, and stringent regulatory frameworks, a world far removed from the speculative fantasies and hopeful rumors that often dominate online forums and social media groups discussing exotic currencies like the Iraqi Dinar and the Vietnamese Dong. For years, a persistent narrative has captivated a segment of aspiring investors, a tale of potential overnight wealth generated by an almost mythical revaluation event that would suddenly catapult these low-value currencies to stratospheric heights, transforming modest holdings into life-changing fortunes. This compelling story, however, consistently collides with the unyielding wall of financial reality as defined by the very institutions that would be required to facilitate such a monumental shift, the major retail and investment banks of the United States. When we directly engage with the foreign exchange desks and compliance departments of institutions like JP Chase, Bank of America, Wells Fargo, and Citibank, the message is not one of quiet preparation or cautious optimism, but rather a uniform, unambiguous, and institutional-wide policy of non-engagement with the Iraqi Dinar and Vietnamese Dong for retail customers. This isn't a temporary situation or a matter of limited supply. It is a deliberate and calculated position rooted in a complex web of practical, economic, and legal considerations that these banks navigate daily. The core of the issue lies in the fundamental nature of these currencies themselves. They are not freely convertible, meaning they are not actively and freely traded on the global foreign exchange market in the same way as the US dollar, euro, or Japanese yen. Their values are either heavily managed by their respective central banks, as in the case of the Vietnamese Dong, or are subject to extreme volatility driven by political instability, regional conflicts, and a profound dependence on a single commodity, oil in the case of Iraq. This inherent instability and lack of a transparent, liquid market create a risk profile that reputable U.S. financial institutions are simply not structured or willing to accept for their retail clientele. The compliance hurdles alone are monumental, involving stringent anti-money laundering AML laws and regulations enforced by the Office of Foreign Assets Control, OFAC, which scrutinize transactions involving certain jurisdictions to prevent illicit financial activities. For these banks, the potential regulatory nightmare and reputational damage associated with facilitating exchanges for these currencies far outweigh any hypothetical future benefit, leading to a clear and present policy of refusal that has remained steadfast for years and continues unabated in 2025, effectively creating a chasm between the hopeful speculation of investors and the operational reality of the Western banking system. Delving deeper into the specific reasoning provided by these financial institutions reveals a landscape defined not by conspiracy or secrecy, but by the cold, hard mechanics of international economics and sovereign monetary policy, a reality that systematically dismantles the common pillars of the revaluation argument one by one. A senior forex compliance officer at a major bank who spoke on the condition of anonymity due to corporate media policies, explained that the single greatest misconception they encounter is the belief that an entity like the International Monetary Fund or the World Bank can simply mandate a new, vastly higher value for a national currency, effectively orchestrating a windfall for foreign holders. This, he stated with emphasis, is a fundamental misunderstanding of the role these international bodies play and the nature of currency valuation itself. A currency's value on the global stage is not a number arbitrarily set by a decree. It is a dynamic reflection of the underlying economic health, productivity, political stability, and foreign exchange reserves of its nation state. And for the Iraqi dinar to achieve the kind of value often speculated online, reaching parity with the US dollar, for instance, Iraq's economy would need to undergo a transformation so profound it would rival or even surpass that of the United States, a scenario that is not supported by any credible economic forecast or indicator. The officer further elaborated on the concept of deleting zeros or a redenomination process often misrepresented by promoters as a covert code for revaluation. In truth, a redenomination is a purely administrative act, similar to a stock split, where a new currency is introduced to replace an old one at a fixed rate, such as one new dinar replacing 1,000 old dinars, a process that simplifies accounting and cash handling domestically, but has zero impact on the currency's international foreign exchange value or the real purchasing power of those holding it. You would simply have fewer physical notes, each with a higher denomination, but your total wealth in terms of its ability to buy goods and services or be converted into other stable currencies would remain precisely the same, a fact confirmed by historical examples in countries like Turkey and Zimbabwe, where renominations occurred without creating any new millionaires among foreign currency speculators. For the Vietnamese Dong, the narrative often centers on the country's impressive economic growth. But growth alone does not guarantee currency appreciation. In fact, the State Bank of Vietnam actively manages the dong's value within a tight trading band against the US dollar specifically to maintain the competitiveness of its exports. And a sudden, dramatic appreciation would be catastrophic, rendering Vietnamese goods prohibitively expensive on the world market and potentially triggering massive unemployment and social unrest. Therefore, the bank's refusal to deal in these currencies is not a matter of being left out of a secret. It is a rational, data-driven response to assets that do not meet their baseline criteria for liquidity, stability, and regulatory safety, and this chasm between the hopeful narrative and the unyielding reality of global finance is both wide and deep, leaving investors in a precarious position outside the formal banking system. This fundamental disconnect between speculative hope and institutional reality forces investors into a shadowy and unregulated secondary market, a space that operates entirely outside the protective umbrella of federal banking regulations and where the risks escalate from mere financial loss to potential outright fraud and total loss of capital. When a major U.S. bank states it does not buy or sell the Iraqi Dinar or Vietnamese Dong, it creates a critical problem. For the holder, there is no official, regulated avenue to liquidate their holdings back into U.S. dollars. This vacuum is filled by a network of third-party exchange companies and online dealers, entities that are not banks, are not FDIC insured, and are often subject to significantly less regulatory oversight, creating a playground for exploitative practices that prey upon the desperation and hope of investors. The most common mechanism of loss in this environment is the massive spread, which is the difference between the price at which a dealer sells you the currency and the price at which they are willing to buy it back from you. While a regulated forex market for major currency pairs might have a spread of a few hundredths of a percent, the spread for the dinar and dong in this secondary market can be staggering, often ranging from 20 to 50% or even higher. This means an investor could purchase dinar at one price, only to find that the immediate sell-back price is a fraction of their initial investment, locking them into an instant and significant paper loss with the only hope of recovery being the mythical revaluation. Beyond the punitive spreads, the logistical process of selling physical currency notes to these dealers is fraught with peril. It typically involves shipping your valuable physical certificates, often via courier services, to a P.O. box or an unknown warehouse address with no guarantee of receipt, no secure chain of custody, and no insurance covering the full value of the shipment during transit. Horror stories about shipments being lost, of payments being delayed indefinitely with endless excuses, or of dealers suddenly slashing their offered back rate after they have received the notes, leaving the seller with a heartbreaking choice. Accept a fraction of what they were promised or try to navigate the costly and complex process of having their notes shipped back. This entire ecosystem functions as a one-way street, meticulously designed to facilitate the inflow of U.S. dollars from hopeful buyers while creating nearly insurmountable barriers for those wishing to exit their positions. And the stark contrast between this reality and the polished marketing of the currency sellers could not be more pronounced, painting a picture of an investment that is not merely speculative but is structurally engineered to be difficult, if not impossible, to profit from through conventional means, trapping individuals in a cycle where their only solace is the next piece of unverified intel, promising that their financial salvation is just around the corner.